brought to you by Borealis Mining.
Michael Gentile, welcome back to the program. Obviously, we've had a pretty exciting month. I don't think you were at Beaver Creek, but atmosphere there was pretty strong. Now we're obviously above 3,800 gold. There's talks of government shutdowns. That still that wider thematic of central bank buy-in and the weaker dollar, etc., sort of driving the sector. How are you feeling in the market at the moment? You've been invested. You've seen this for years down the track. Last time we spoke, obviously you've been well positioned and took a big gamble in your career, really, when you made the shift into making these investments. What, how's the portfolio looking at the moment? What are you looking at mostly with, and how are you spending your time in a market condition like this?
Yeah, it's I could say, Peter, it's gratifying because I felt like a farmer who planted a crop in 2018 and 2019, and the weather conditions were perfect for 6 years. The sun was shining, just the right amount of rain, and yet none of the plants were growing at all for 6 years of staring, looking at my field and continuing to plant more and more seeds as I saw more and more opportunity, and the weather was so good. And finally, in the last kind of 3 to 4 months, that the market's waken up to some of these themes I've been talking about almost nonstop since 2018, 2019 on the interviews like this, vis-a-vis gold and hard money and precious metals. So very gratifying. It was a long, frustrating period to not get recognized, especially when the macro call was spot on and the gold price was doing very well. So it's gratifying to see the moves in the juniors. I was talking to one of my partners today and say the stocks have moved nicely, but in a large degree, it's a bit of a catch-up trade for 4 or 5 years of no price response to very, very positive fundamentals. I'd also say it's gratifying finally to see the mainstream financial markets and investors slowly start to wake up to this theme again that I've been talking about for many years. So, we've spoken, Peter, that the large degree of the gold price move up until the last, let's say, 3 to 5 months has mainly been driven by physical central bank demand, which is really what got me most excited about it, because the previous rallies the last 20, 30 years have really been driven by financial markets, speculation, and which are very fickle and short-term in nature. But the central bank buying is really, in my view, a mega trend and absolutely right kind of buyer that you want: sticky, long-term, and relatively price insensitive. What we've seen the last little while is mainstream financial investors and retail investors wake up to that theme. And when gold crossed through 3,000, I think that was sort of the first shot across the bow, when investors realized that it wasn't going through 3,000 for a cup of coffee and going to fall back down, but actually keep going. That's what started to pull more mainstream money in the sector. But I still think we're pretty early in this adoption, mainly because nobody owned this stuff until 3, 4, 5 months ago. So there's really still a massive underweight position across portfolio managers, allocators in general. I'm not saying we won't have pullbacks. There will be volatility when you have something that goes up this much as quickly, but I still think we're very early in the market recognition and allocation to gold and hard assets. But it is finally gratifying to have some company. I've made a joke. I felt like you guys watched the Big Short movie when Michael Burry played the guy with the headphones and playing heavy metal on his drum set. And I kind of felt like that in my junior mining portfolio, that I kept on buying these stocks and knowing that I was right, or feeling that I was right, and waiting for the market to come around. It is gratifying, but I especially in the small resource sector, junior names, below PEA resource stage, I think there's still a lot of room to run because these stocks have been so undervalued for so long.
Well, that actually leads me on to my next week, because one of the main things I wanted to talk to you about today was, obviously, now that we have seen this run over the last month, beginning of September, we started seeing real parabolic moves in share price performance. And obviously gold's really looking strong. Silver's gone on an absolute tear, but it's almost a steady one, unlike the highs that we've seen in the years gone by. Um, there's a feeling among investors that they've missed the boat. How are you looking at it? Are you making new investments, or are you focusing on your existing ones? Where are we in this cycle?
Yeah, I think I think they have not missed the boat. I think, like I said, in any rally, I think we're in a multi-year bull market for precious metals equities. So at any time you're in a multi-year bull market and you have a big move like we had, a pullback would be healthy and expected.
Yep.
But I think on the longer term basis, you look at where investors were at the beginning of this year, I think that 0.5% of the global investable assets. So 0.5% of the global investable assets allocated to gold and precious metals, equities and physical gold. If you look at how important gold is becoming to global trade, what China today just announced, I believe that they will not take dollars on iron ore trade. They want it to be gold based. So you're
Wow.
seeing China and the BRIC countries really pivoting towards moving more and more trade away from the US dollar into, gold, because their currencies are not yet accepted as reserve type currencies, that they want to back it with gold or encourage more trade in gold for a way to get around the US dollar. If you see the percentage holdings of gold on central bank balance sheets, crossing treasuries ownership for the first time in 50, 60 years, you're seeing gold becoming, number two to the US dollar and trying to close that gap every day. So when you think about the importance that gold is now asserting in the monetary system, the fact that 0.5% at the beginning of this year was allocated from all investor pools to gold tells you how under-owned the space is. Does that not mean that we can see a 20% pullback in the gold producing stocks? Absolutely, you could see that. But I think the fact that maybe at 1% today is still a very, very nominal amount in terms of the importance that gold is going to play going forward in the monetary system. So that's an under-owned theme. You look at the importance of AI, nobody's doubting AI in terms of the future, but gold is really asserting itself as a key pillar of the financial and monetary system again. And not enough people, most people don't own any gold at all or own very small allocations in their portfolio. So I think that's a mega trend. And within that mega trend, you will see pullbacks. The other thing I'd say too is on the smaller side, Peter, I saw an interesting stat that another man from Montreal sent me recently that I think is really, really fascinating. He did a study showing going back like 100 years and the price paid for resources in the ground versus a spot gold price. And he said on average, the average value per ounce of a resource in the ground, not reserves or resource, was 10% of the spot gold price.
Wow.
With gold knocking on $4,000 an ounce, that's a $400 an ounce number. Now, I'm not saying every company that you own your portfolio should trade at $400 an ounce an average. Some are close to production and have a higher value. Some are very stage of lower value, but very few companies that I follow are trading anywhere above $100 an ounce. And the gold price has gone up so much that it makes sense. The value of the gold you have in the ground is a function of what's a spot gold price. So if you have 2 million ounces in the ground and gold is 4,000, it should be worth twice as much as it was when it was 2,000. So with most names trading below $100 an ounce, 10% of spot being 400, and the gold producers basically minting money and minting cash on a daily basis, you should see inflationary upward pressure on the valuation of in-situ ounces in the ground. And so where I've seen the most value, Peter, since 6 years ago, and definitely most true today, would be in the resource stage companies, the pre-PEA or PEA stage assets and below, that have been starved of capital for the last 6 years. Just now, finally a financing window opening, that are still trading at very low valuations and that are increasingly attractive to larger companies who are generating lots of cash, needing to replenish their reserves, and thinking about growth again for the first time in many years. So I still see a lot of value there. In some of the producing assets, yeah, depending on what gold price you use, and the larger, the more liquid names are probably getting closer to near-term fair value. There's always some exceptions there, but I see a lot of value down cap, which is always the case in any cycle where the larger companies rally first, then the mid tiers, then the small producers, and then eventually the market gets to the junior resource stage companies. But up and down, I see a long-term trend that will be supportive of gold, and I still see quite a bit of value. It's getting a little harder to identify new names than it would have been like 4 years ago. I would do 10 calls and want to buy 8 of them, but only end up buying one, but having really a pick of a litter. Now I might do 20 calls and maybe want to own one because it fits the parameters and the value that I'm looking for. I have very strict criteria for when I make an investment. But that being said, I've still made, multiple new investments in the last, 6 to 8 months. So I'm still finding the value, but yeah, you got to work a little harder. And you got to look for things that are not yet recognized by the market, which is slowly starting to wake up, which makes it a little bit more of a race and more difficult to find those unrecognized names.
Yeah, especially when we're in a bull market like this, we are obviously seeing a lot of companies rehashing old projects, but, blowing the dust off them, lowering the cutoff grades, etc. Sort of putting a nice new shiny bow on it. And I guess from your perspective, you said there you've got a criteria of what you're looking for, especially in the resource stage. Would you be able to sort of run us through sort of the basics as to what that would look like? What's compelling to you in a resource stage company?
Yeah, it's a great question, Peter. I would say if you're a long-term investor like I am, like my time horizon is 3 to 10 years when I get involved in an investment. And I'm looking for assets, even though I might be buying it at a 20 million or $30 million market cap. I'm looking for assets that have potential to become a mine because I'm really looking to make, 20 to 50 times my money off my initial purchase price.
Yeah.
And the only way you do that in a mining sector is really if you find assets that become mines. And so my criteria, what my advice to the corporates I'm talking to and to real investors that I'm talking to is in a rising gold price environment, don't lower your standards. And you're gonna I'm probably asking viewers are gonna get mad at me because in a rising gold or silver price environment, the crappy assets, part of my French, the crappy assets will go out more than the quality assets. People will start chasing lower quality, like you said, taking an asset that could never work at $3,000 gold or lower, but could make money at $4,000 gold. And you can make a lot of money chasing that stuff. But the reality is, unless gold goes to 10,000, that asset's never going to get built. And the real reality is you'd rather build an asset that can make money at $1,500 gold than an asset that only makes money at $3,000 gold. So I'm looking for assets that are on the lower end of the cost curve that could get built in a $2,000 gold price environment, but could make oodles of money in a $4,000 gold price environment. Not assets that will only work in a dream gold price scenario, $5,000-$10,000 an ounce. So that's one. Second thing would be for gold producers. The danger would also be that gold price is high, so let's lower our cutoff and let's start producing more gold. You can do that. In some cases, it is an economically justified decision, but you don't want to start building your mining plans around $3,000 or $4,000 gold
Yeah.
and then have your costs ramp up, and then the gold price pulls back, and then you have a hard time reining in those costs or reining in that high cost production. So there's going to be a balancing act between, building higher gold and silver prices in your models and not getting too carried away and funding bad projects. We saw that in the last cycle in 2000 when people got a bit over their skis, a bit of wild M&A, overly aggressive assumptions on gold price and cost, end up destroying a lot of capital in the industry. I don't see that happening right now, Peter. Companies are being very disciplined, but investors also need to be disciplined about understanding, okay, what's actually going to get built this cycle, what's not. And if you want to play that trade and could understand you're renting these stocks and you're speculating on them, but they're not likely to become mining assets in the future, but they could be really good stocks in the short term. I just won't be playing in that corner of the market.
Hi, I'm Kelly Malcolm, founder and CEO of Borealis Mining. We're reigniting gold production in Nevada, one of the world's most attractive mining jurisdictions. Our flagship Borealis project is 100% owned and fully equipped for production today, with power, water, workforce, permits, and even a modern ADR facility already in place. We've started crushing high-grade stockpiles, and our first gold pour is just around the corner. Historically, Borealis produced over 600,000 ounces of gold, yet much of our 21 square mile land package remains unexplored. With nearly 2 million ounces of historical resources and past drill results up to 67 meters at 16 grams per ton, the upside here is tremendous. But Borealis is just the beginning. Through acquisitions like our nearby Sandman project, with a strong PEA showing 35,000 to 40,000 ounces per annum and a $121 million NPV at $1,800 gold, we're building a hub and spoke model designed to deliver scale and efficiency. Our vision is bold: to grow into a greater than 100,000 ounce per year Nevada powerhouse within the next 5 years. With a proven team, strong shareholder support, including mining legends Rob McEwen and Eric Sprott as major backers, and multiple catalysts ahead, we're positioned for both near-term cash flow and long-term growth. Follow our journey at borealismining.com or connect with us at info@borealismining.com.
Yeah, I think you mentioned there obviously M&A in the past in the last cycle. I think a few different reports show about 80% of those deals were value destructive. We are now seeing sort of more almost divestment from the majors than M&A as such, in terms of acquiring new assets for the portfolio. There is obviously just a real lack of good development stage, sort of entering production stage assets out there. There's a good handful of them that might have that magical 5 million ounce reserve, which is really something that a company like Barrick have always come out and said, is that if they're going to do M&A, they need a minimum of 500,000 ounces over 10 years, 5 million ounces in the ground to make that investment. Um, are there any stories that you're looking at within your own portfolio, or are there any stories that you think have the potential to go on to be these big next projects that are still out there, that perhaps aren't already in that development phase? Have you seen, even just from a geological perspective, are there any trends that you sort of like and are looking at the moment?
Yeah, so I'd say two ways. I think you're right. I think the Newmonts and the Barracks of the world have realized if you want to produce 5 million ounces a year, it's a lot easier and cheaper to have 10 mines producing 500,000 ounces a year each than have 25 mines producing 200,000 ounces a year. Just in terms of G&A management, it looks good on a spreadsheet for a financial guy like myself, but the amount of horsepower and capability you need to run those 25 mines effectively really dilutes the quality of your organization, and you have issues because you can't have 25 A teams running 25 assets. You have a limited number of A human resource teams that you can do. So that's what you've seen Newmont and these companies do, is selling down these assets that produce 150, 200,000 ounces a year. And many of them are decent quality assets. They're not of the size to attract. So when I invest in producers, Peter, I do like to look for assets that I think have the potential to be attractive to the larger mining companies. And that's that magic 500,000 ounce per year threshold. They're very, very scarce assets. So a couple that I own and like quite a bit is K92 Mining. It's a producer of 160, 180,000 ounces a year currently, but on a glide path to 300,000 and 500,000 ounces a year, 10 million ounces plus resource growing by the day. That's an asset that organically, without any dilution, can grow to that tier one status and should be highly coveted. Iron Gold's Cote has a 300,000 going to 500,000 ounce production profile. Those are very rare assets. It's rare that you see them in mid-tier mining companies. Usually they get acquired. And then the next step down would be what assets in the, pipeline of emerging assets can be producing at that level, right? And, North Isle Copper and Gold is one that I own in BC that has, a very attractive project that could, start with a couple 100,000 ounces of gold equivalent per year and then grow into phase two, like a half a million ounces a year, kind of like what Artemis has done. So Artemis is another one that's in that kind of phase two, tier one potential size assets. So those are extremely rare, and they're not easy to find or to own, and therefore they have a scarcity premium around them. And you'll see more M&A and more divestiture and more kind of horse trading around that as companies try to reposition their portfolios. But in general, I was just talking to a mining CEO today who was in my office of a mid-tier mining company, and they were saying that there's very, very few assets left to buy. Hemlo just got acquired, was sold by Barrick. So even in the 150 to 200,000 ounce per year or less kind of category, there's very few producing assets left for sale. And so that comment led me to conclude, I think rightfully, that the next wave of an M&A is going to be in that developer stage, guys that have a PEA or a PFS, or in the resource stage that have high quality resources that the corporate say we can build this, because there's nothing left to buy in the producing assets. The tier one assets are extremely scarce. You're going to have to move down and build it yourself if you want to find new production. And that's another, I think, validation of the valuation room that's left in the smaller spectrum that has yet to be exercised in the market.
Something that's always, well, I guess, been a hindrance to that has been permitting in recent years. A lot of the larger companies almost want to wait for the permitting to be completed before they take the risk of actually, obviously, acquiring it and going to build it. Do you think, given where we are at the moment, like we said, there's very few of these actually left? They're almost unicorns. These big deposits that are permitted, either in construction or ready to be built, or even in production in a mid tier. Do you see the majors sort of coming down the food chain and thinking, well, we can't wait for permits to be granted now. We have to start picking these things up earlier.
Yeah, I think you're right. The company in question that I met today, just got out of that meeting, has just acquired a non-permitted development stage project. And their response was, yeah, you can wait for the permitted assets in the high quality jurisdictions, but there's so few of them that you're going to pay a massive premium for that. And there's a lot of competition for those assets. And so their conclusion was, we have a build team, we have local knowledge, we can permit this asset, we know how to get it done, probably faster than junior mining company can. So there is value in that. And so, yeah, I think you're right. The producing assets are gone. The permitted assets are few and far between, and probably going to go for very high prices. So you have no choice if you want to keep your pipeline full, but to go down cap. And I do think the larger companies have the financial resources, the human resources, and the expertise to unlock permitting. And why would you want to wait for something to be fully permitted if you're confident you can do it yourself and pay a massive premium to what you pay now? So I think you're going to see that tension building, Peter, that you will see more M&A in the non-permitting assets. And you are seeing slowly but surely, at least in my neck of the woods, Canada, USA, a general movement back to some more pragmatism on permitting. And so the timelines are still incredibly long and too long in my view, but the governments are saying the right thing, recognizing there's a problem there and needing to shorten those timelines uh, in an expeditious way to unlock value and have these critical metals and precious metals produced more quickly in their countries.
Yeah, agreed. I just want to go back up more onto the macro side of things just for a moment. So you were mentioning there China exchanging, essentially asking for gold in exchange for iron ore, etc. You are seeing this sort of move away from US dollars. This all started when the West kicked Russia out of the SWIFT system, and everyone started sort of panicking that they could be next. And essentially, if you're too over leveraged on US dollars, you could just be shut off overnight and left in a pretty dire economic situation. So you can, I understand why all of these companies are doing this, but looking at and how that impacts gold, but looking at silver, I just wonder how you look at that market when we've seen silver get up to the sort of prices that we've seen at the moment, where it's sort of $48, almost reaching 50. They've usually been very, very sharp spikes, and then they've come back down. This seems a bit more almost structural and I guess a bit more steady, even though we are seeing an increase over, I guess, over a rapid period of time in historic context. This just generally feels like it's not so much about shorting or about market manipulation like it had been in the past. This is really essentially about this structural deficit we've seen in silver for the last 5 years or so, plus then also the investment demand that we're seeing on the precious metal side as well, looking at it as a precious metal. Where do you see silver going? I always hear people more recently, obviously, calling for $100, $120, $150 silver. A few years ago, you'd call someone like that nuts. But how are you seeing that market now?
I've always said I don't look so much at the supply demand imbalance in silver. At the end of the day, silver is a poor man's gold. Everyone calls it poor
Mm.
man's gold. But I really use silver as a proxy for mainstream interest in the precious metal sector. And so I said interviews many, many months ago, just when silver started to rise. I said that was one of my more exciting tells that the junior resource market was going to start to come alive. Because for much of the rally the last 2, 3 years in gold's been going up and silver has been doing nothing. And that was again because we said central banks were the main driver behind the gold price move, physical demand for gold. And central banks do not buy silver because if you wanted to have a reserve currency backed by silver, you need like 175 football fields full of silver warehouses to actually make it a meaningful amount of money to back your currency with. So really, silver was not rallying because the mainstream public was not all interested in precious metals. Really, only central banks that were moving away from like you said, the sanctions on Russia, the BRICS desire to diversify away, fear of the US dollar. We've talked about that ad nauseum over the last several years. So the silver rise recently, Peter has told me that mainstream retail and financial investors are starting to get interested in the precious metals theme. When you talk about $50 silver, I mean, silver is still poor man's gold, tied to gold. So the fact that gold has been so strong gives silver a larger umbrella at which to trade at a higher value and still be relatively attractive versus its historical patterns relative to gold. So last time silver hit $50, 2011, gold was around $2,000 an ounce. Today it's close to $4,000 an ounce. So just on that basis alone, if you had a similar type, you know,
Yep.
participation of silver versus the gold, you'd be at $100 an ounce. So I don't think that I'm not here saying silver is going to 100, but I think if you have that type of retail interest and mainstream participation in the precious metals market, there's definitely more room for silver to make new all-time highs than it did in 2011 and the last time the Hunt brothers cornered it in the 70s. So I do think there's room for silver to run. And I think the more silver runs, the more it's telling you that there's broader interest. And that's also probably very, very positive for the equity space, the general equity space, because it shows you that this rally is broadening out and not just limited to big financial buyers and central banks.
But if we believe that this is a multi-year gold bull run, and obviously we've got this thematic underneath it, like we were just saying with the central banks, etc., and then therefore you're essentially saying silver's a proxy for gold with the wider market. Does that mean that the way that you look at silver is that silver in theory should be trading similarly to gold moving forward, and this isn't a, like we've seen before, a big rally up and a big crash down? You're not expecting a crash in the silver price once we hit 50 like it has done in the past?
No, I don't think so, because I think I said silver to gold ratio is still very, very reasonable in terms of value versus its historical levels. So no, I think the way silver has a major retreat, if the gold price has a major retreat, obviously it would fall. But I think silver should participate, and realistically, if this gold rally continues, silver should have a higher beta than gold. So if, it should have a more than 1-to-1 ratio with gold price appreciation going forward, and that should be again very, very positive for the equity space as well.
How much exposure do you have to Mexico, in regards to silver equities? I know you're an investor in Capitan. I'm not. I think you might be involved in a few others. Um, Obviously, the big thing in Mexico, which is really going to move that market, is line of sight on permits. So have you heard anything about everyone I talk to on that space? They are expecting permits. They have been for a while. It's obviously been delayed. But you do have other people that have a completely different opinion, where they just really don't think that any open pits are ever going to get processed.
Yeah.
What are you hearing in the market?
Yeah, so I'm a big investor in Capitan Silver. It's my favorite, hands down, silver name in the sector. I think when you invest in a foreign market, local management and understanding is extremely important to me. So Capitan Silver is run by a Mexican-based team. The CEO, Alberto Orozco, is head of the Sonora Mining Association. So he's chairman of the board of the Hedge Group of Mexico and Fresnillo. So we're a 150 million market cap company, but the chairman of the board is our CEO, and then there's multi-billion-dollar CEOs set on the same board as him. So it gives you an idea of how local and how connected they are. I only bring that up because I do feel I have got a good insight into Mexican, political and mining motives. And I'm not omniscient. I don't have all the answers, but I also been heavily invested in some Mexican mid-tier producers. So across the board, what I'm hearing, Peter, is things are getting better in Mexico. AMLO was a volatile and overtly or semi-overtly hostile to the mining industry. The new prime minister is much more pragmatic, and you are seeing some permits slowly trickle out. They are saying the right things to mining companies behind closed doors. They recognize the need of the industry to be present in a responsible way. So I think you're going to start to see those permits get unlocked, and you're going to start. And I think with all the geopolitical noise we're seeing, we're seeing it in Canada as well, right? Like there's major resource wealth in Mexico, and mining's a big part of their GDP. And so there's a pragmatic view that, if trade is getting more difficult globally, we've got to focus in, like Canada is, on developing more of our resources and creating more wealth within our borders. So I do expect things to get better with some volatility over time. But you really want to be in companies that have a lot of experience operating in Mexico, have the right political connections, have the right local community support, and understand the process well. And so that's why a company like Capitan not only has great geology, but I am very, very confident that that team at Capitan built Argonaut Gold's 200,000 ounce a year gold platform for them many years ago. So they've got the operational expertise, they've got the political knowledge, and they know the geology very well. And so therefore it de-risks your permitting risk or your local, risk significantly versus a company getting run out of Vancouver or Toronto, where they fly in once a month and don't really know what's going on the ground on a regular basis.
Yeah, in terms of what you're saying with what you're hearing behind sort of what mining companies are hearing, I'm hearing the exact same thing. So fingers crossed we start seeing some movement there. Obviously I think you're in town, you're in London next week, aren't you?
Yes.
And you're roadshowing. How many companies is it that you're taking with you to London?
Yeah, I'm doing a European roadshow, 5 cities in 5 days, starting in London on October 6th. Then I'm heading to Paris on the 7th, Geneva on the 8th, Zurich on the 9th, and then Frankfurt on the 10th. And the idea, Peter, is really to, been limited travel the last 5-6 years, family reasons and COVID, a bunch of things were happening. So we're looking forward to meeting investors face to face. The presentation will focus on what I look for in a mining investment, and junior mining investment, explaining to investors my approach, what are the significant hallmarks of successful investments in my opinion, how I allocate capital. I take a bit of a venture capital approach to allocating capital in the space. So I'm going to go through a 25-minute keynote presentation during lunch. And then I figured, other than explaining to investors how I like to invest, I then brought 6 of my largest investments in my portfolio with me on the road to give investors, 10 minutes each on a quick elevator pitch on those companies. So they can hear my theory and what I look for, and they can see it in practice all within a 2-hour lunch format. And I'm bringing with me on the road North Isle Copper and Gold, Radisson Mining, Northern Superior Resources, Capitan Silver, Group 11 Resources, and Astra Exploration. So I get a cross section of different commodities, different jurisdictions. But the investors that attend these lunches will see these are very similar hallmarks of companies I like to invest in. It doesn't guarantee success, but I do feel that it increases the odds in your favor of making a successful investment in a space where failure is the norm, right? We're looking for big returns, means there's going to be some failures, but I try to put the odds on my side by stacking the cards in my favor by looking early on what are the key success factors for a successful junior mining investment.
Really, at the moment, so for example, with in terms of investing in this sort of market, really the main focus at the moment, you think, or the main value to be had should be in resource stage companies, but you really need to keep an eye out for quality and potentially companies that will have a decent margin down the line. Just a quick one on that as well. So companies that are, say, people are watching this and then they want to go out and look at some junior stocks. Obviously, please do so at your own risk, because it's a highly volatile market. And odds are most people lose more in mining than they usually make. Maybe not in a bull run like this, but in general they do. We'll be really careful. When there aren't economics around a project, it's quite hard sometimes for someone who isn't a geologist or isn't sort of been in this space for a very long time to understand which projects have the hallmarkers of being a high margin project and really fit that criteria you're talking about. I was wondering, just to finish up, how we could maybe just dial in a bit more on what type of projects, what type of deposits that we should be looking for.
Yeah, so mining is, modeling a mining operation is incredibly intense and difficult endeavor.
Yep.
But it's actually, if you want to get to a level of specificity to get to like within 1% of the right IRR for a project.
Yeah.
But what I often like to think about is actually quite a simple mathematical endeavor if you want to take a high level look at a project. And so basic building blocks of how do I assess if a project's going to be economic? You start with the grade, right? So what is the NSR value per ton? Like how much value per ton of rock you're going to move is there in gold, silver, or whatever commodity that rock is present in. And then you want to look at what is the capital cost, right? What's the cost to pull it out of the ground? So what would be the mining cost to move that out of the ground? And that's pretty standard. You can find that across jurisdictions and contractor rates. You can figure that out. And then the big one investors just figure out, so that gives you your grade or your value per ton of rock you're going to move minus your operating costs to get out of the ground. That gives you kind of your cash margin per ton. How many tons are you going to move in that project? So how big is the project? How many tons or how many ounces do you have in the ground? And then really crucially, you take that gross cash flow, back of the envelope cash flow, and you divide it over the infrastructure that you have to build. And there's 2 buckets of infrastructure, and often investors forget the most important one. The first one is the obvious one: the mill, the plant, tailings facility, all the classic mining infrastructure you have to put in place to produce the commodity you want to get out of the ground. But the second one is all the associated infrastructure: the airport, the roads, the port, the power, all those accessibility. How do you have to build a camp? Do you have to build a town, or is there already a town present? That infrastructure can often run double or triple or more the actual cost of the mining operations in terms of capital. And so I look at both those together, and I have a preference for projects that have infrastructure already in place, because you don't have to build it twice. And so I take the cash flow from the rock coming out of the ground over the capital required to get the project into production, both the mining and then the infrastructure. And that gives you a back of the envelope. If you're pulling out $300 million a year of cash flow out of the ground, and your thumbsuck cost to build the whole project, including the associated infrastructure, is $600 million, well, that's a 2-year payback, right? So you go, and then the mine life is 15, 20 years. So that's probably a project that has a good chance to become economic. Whereas if you find 1 million ounces in the middle of the Yukon, and it's going to cost you $1 billion to put in roads and power and infrastructure, you're quickly going to figure out in your mind, I need to find 10 million ounces. Like I need to be snowline gold to justify the infrastructure there. But if you're a smallish deposit in the middle of nowhere, you might have ounces, you might have a flashy press release that shows really high grade, but if there's not size and scale and the cash flow able to fund that infrastructure, you're never going to get built. So in a very simplified format, there's obviously a lot more that goes into that, metallurgy and all kinds of other things, but that gives you a bit of an idea of how my mind would work. And so when I find a project, even if it's got a $20 million market cap, I'm looking at the infrastructure. I'm looking at the geologic potential of the Kent, assets that I own, assets I don't own yet. But is there enough cash flow, scale, what do you want to call it, over the capital required to build it? If there's an empty mill next door, if there's a road that drives to 5 or 6 mills in the same area, that will dramatically lower the hurdle of what I have to discover geologically to make it a profitable investment. And most investors get fixated on just what's the drill result, what's the meterage, what's the width, what's the next piece of news that's coming out. And they don't take it far enough to go, well, that's nice, but what does this actually mean 5 years down the road if you actually want to have a successful mining operation? And it's fine if you just want to trade these stocks and be around news flow, but I'm looking, like I said, for a 3 to 10 year horizon, looking to own eventually producing assets or mining assets. Very hard to find them. But if you get a few of them right and you buy at the right point of the cycle, that's how you make significant money in this space.
No, agreed. Michael, really appreciate your time. Thank you.
My pleasure, Peter.